Okay, so the first thing I'm going to look at is Bollinger Bands. You're probably wondering what I've got all over my charts today. If you're not familiar with Bollinger Bands, we're going to go through them now. So basically, just visually, I'll show you what they are. They work like as an envelope around the price. They don't work so well in a trending market. So you can see from the Aussie dollar here, Aussie US, the market's been pushing higher since March last year. Now, they wouldn't really have been an awful lot of use to you, these Bollinger Bands. Okay, selling, for me, selling into resistance in a rising market isn't the safest strategy. I'm looking to buy into weakness to a support level, which might be found with a trend line or a Fibonacci or some of the other moving averages that we generally use. And then maybe even buying a break above resistance because you're in a bull trend. Basically, when you trade with a trend, your life is so much easier. I've done the opposite when I first started trading. The market goes up a lot. You think, well, it's gone up so much, it can't go up anymore. Surely it must come down. So you wait for it to be overbought, and then you sell into it, and the market just keeps going up. It's happened to me so often. But what I found was when I trade with a trend, even if I get in at the wrong price, when I say the wrong price, even if I get in at a bad level, I buy too early. Eventually, the market will bottom. And, you can also think, well, I bought too high, I was too anxious, but we've hit a really good support level, so I'm going to buy a little bit more here. And eventually, of course, the market does turn around and pick up and keep going. And eventually that losing trade will be carried up and you'll go into a profit. You'll just kick yourself because you got in too early maybe, but eventually the rising market will take you up with it. It's just so much easier to identify a trend and stick with it. Trading against the trend, really, forget about it. It's too stressful. It just kills you in the end. So Bollinger Bands, yeah, they don't necessarily really keep you in a trend, but they can offer good support levels. But as you can see here, you often don't even get down to the lower end of the Bollinger Band in a strong trend. So I wouldn't necessarily use them for that. But when you see a market that is trending sideways, that's when Bollinger Bands really start to come into use. Not just on their own. Use them with other tools that I will show you and that I use every day, that you've seen me doing for the last few months. But certainly in the short term, Bollinger Bands do work. And actually, they were off my radar. I wasn't really using them. I'd forgotten about them, to be quite honest with you. So I'm really grateful for the suggestion to revisit them, because we really have been in sideways trending market now it's getting on for 2 months. And really, you can see how well the Bollinger Bands. Let's just zoom in a little bit. You can see here, certainly as the market was slowing down and starting to establish a sideways range, they were becoming more useful. You could see, you saw on the daily chart there with the Aussie when it was trending up, the parameters were not really getting hit. They were not really of any use whatsoever. Now, this is the 4-hour chart, and as the market started to trend sideways, then we are starting to get some use out of the Bollinger Bands. So on the downside, we're holding support. On the upside, you can see, the blue zone is where the market should stay within. So as it reaches the outer parameters of that zone, you would expect that to be resistance up at the top, support at the bottom. Now, you can see that has worked pretty much everywhere, buying into support. Now, this is can you see here? This region here, we actually had a decent move. That's where it wouldn't really have worked. If you were buying into support here thinking, oh, it's hit the bottom of the Bollinger Band, you would have lost money. So it's not foolproof, but it works better as markets stabilize and trade sideways. You still have to use stops. You don't know where the market might break and move, and you'll get caught. But certainly now, as we start, the ranges start to narrow, the market starts to stabilize here, then you really see this starting to work. Resistance here, support here. Yes, we overran a little bit. Resistance here, support down here. Then we get a move. So here, if you were selling at this Bollinger Band level here, you'd have got stopped, and then would have had to have waited until you thought the market had stabilized again. And then, of course, Bollinger Bands here start to work very well, very well. This is around the middle of April, so around Easter time, I think, when the market really started quieting down. This is when they really kicked in. Now, you'd have had multiple trade opportunities in this sideways trend, as you can see, all the way through. Then again here, we break, we push up, but finally we come down, and then the market stabilizes again. So this period, the Bollinger Bands would not have worked very well, sort of around, that was second week of May. But then again, since that period, then the Bollinger Bands are working nicely as the market trades sideways. So I think actually the best thing I can do is to, I'm just going to shrink this. If you want to go into Bollinger Bands in more definition, Investopedia is a fantastic website, really, really good to study the technical aspects of the analysis. You know, what I mean by that is the indicator side of technical analysis. They really do explain things very, very clearly. So actually, there's a lot more about Bollinger Bands here if you want to understand how they're calculated, if you want to learn about John Bollinger, who developed them. But basically, rather than me talk off the top of my head, it's much easier if we just read it from here. So the Bollinger Bands, well, they're a highly popular technique. So as I've said to you before, as the market moves to the upper band, that's considered to be overbought. And then as you move to the lower end of the band, the market is considered to be oversold. It doesn't actually say here that they're more useful in a sideways trending market than in a directionally trending market, i.e. up or down. But that is exactly what I have found, and as I've just showed you with those examples on current charts. So this is an example of how this is explaining how they are calculated. Now there is an aspect which I don't actually agree with, which is maybe a bit arrogant of me because I'm not John Bollinger, but so they're based on standard deviation, which is a measure of volatility. When the markets become more volatile, the bands widen. So I'll just show you an example of that. Now you can see that here. So as the market was quiet, the bands start to narrow, and then of course as the market gets more volatile, they widen. I don't think that's of any use particularly to anyone. That in the definition, it claims that it is useful because well, it says that when the bands come together, when they close together, constricting the moving average, it's called a squeeze. A squeeze signals a period of low volatility and is considered by traders to be a potential sign of future increased volatility and possible trading opportunities. Now, okay, I shouldn't really disagree with the official way of using Bollinger Bands, but to me that really is actually rubbish. Because of course when markets become less volatile and they just don't move very much, well eventually they're going to move and they're going to break. But this does not give you any time scale. It doesn't say to you, right, the Bollinger Bands have got so close, so within 3 to 4 days we're going to get a breakout and the market's going to have a dramatic move of X%, or it's going to go to, you know, so that really is of no use to anyone whatsoever. But anyway, that's in the definition of Bollinger Bands. Conversely, the wider the bands move apart, the more likely a chance of a decrease in volatility and the greater possibility of exiting a trade. Again, I think that's absolute rubbish. And I wanted to show you this because if you go off afterwards and you read this after I've talked about Bollinger Bands, you know, there's this sort of definition all over the place. I wanted to run through it with you. I mean, to me, that's of absolutely no use whatsoever. If the bands move apart because the market is very volatile, it does not make the chance of a decrease in volatility more likely. And even if it does, when? You know, tomorrow, next week, next month. So personally, I don't find that useful at all. Having said that, Bollinger Bands are extremely useful. I just wanted to drill down into the definition for you and give you my take on it. Okay, it does actually, to be fair to this, the paragraph, it does say, however, these conditions are not trading signals. The bands give no indication when the change may take place or which direction the price could move. Okay, so fair enough. I hadn't actually read that far. So that kind of confirms what I'm saying. Maybe when the bands widen out, it does mean they will come together, and maybe when they come together, it does mean they'll widen out, but who knows when. So really absolutely useless as far as that's concerned. So it says approximately 90% of price action occurs between the two bands. Well, it probably does, but again, really only when the market is moving sideways. Any breakout above or below the bands is a major event. Fair enough. You know, that can help you identify a breakout as well as trend lines, as well as moving averages. The breakout is not a trading signal. Well, it's not a trading signal, but you know, if the Bollinger Bands can help you identify a breakout of a sideways range, then that coupled with maybe a break above a Fibonacci level or a break above a trend line or a moving average can actually indicate that there is a breakout and that you should go with the trade, especially if we're in a consolidation period. So look, Aussie dollar is not a good example of this. Let me try and think of a market that would be US dollar CAD. Right. So here again, on the Bollinger Bands. Now, not really a whole lot of use when the market is trending lower. You know, buying into support in a downtrending market, not a clever idea. Just as I said, selling into resistance in a rising market, not a clever idea, not the way I trade. So Bollinger Bands, yeah, not really much use to me here, I don't think. Now, this is when they come useful, because the consolidation phase has started on the shorter term charts. You can't see it on the daily chart, but on the 4-hour chart, here's where the Bollinger Bands come in useful. So to be fair, on the 4-hour chart, I must say, look, they're more useful, but that's because the consolidation patterns are more clearer on the 4-hour chart. So even though we're in a downtrend, you're more clearly seeing the Bollinger Bands work when the market does trade sideways. Then we start to move, and the Bollinger Bands are basically no use whatsoever. Here again. Now, let's just zoom in and really take a close look at this. Let me grab it. Okay, so right, this is the consolidation period. This started around the middle of May, so we're looking at about a month now of consolidation in the dollar, in the US dollar versus Canadian dollar. And as the market starts to slow down, then right here is where we really see the Bollinger Bands come into effect, where the sideways trend is really starting to be established now. And actually, this is where, you know, the kind of where I've drawn the trend line, you know, where I've decided that the sideways trend has been established, and you can see from there the Bollinger Bands are also reinforcing that message. So on the upside, there's my trend line, and that coincides beautifully with the upper parameters of the Bollinger Bands. On the downside, here's my lower trend line, and the Bollinger Bands are actually doing a better job than my trend lines of holding the downside in the sideways trending market. Okay, now, according to that definition that I just showed you, once the Bollinger Bands are broken, we're waiting for the breakout. Now, for me, the most likely breakout direction will be to the downside, because the prevailing trend is negative. We are in a downtrend. We're having a consolidation pattern, I believe, in a downtrend. This is not a basing pattern or a reversal pattern. So I would be expecting the market to break. Now, so for example, if we started to break below today, if we started to collapse and get below 120.60, you have to wonder to yourself, well, is this a breakout of the Bollinger Band? So in that respect, it is useful. It would also have broken the short-term moving averages and other things. Okay, so I hope I'm giving you an idea of how it does work, and perhaps somewhere where I'm not always agreeing with what's written about the Bollinger Bands. Let's just read about the limitations. Bollinger Bands are not a standalone trading system. Absolutely not. They're simply one indicator designed to provide traders with information regarding price volatility. Well, I would say that about all the technical indicators. You know, I look at slow stochastics, but I certainly wouldn't base a trade off that. John Bollinger suggests using them with 2 or 3 other non-correlated indicators that provide more direct market signals. He believes it's crucial to use indicators based on different types of data. Some of his favorite technical techniques are moving average, divergence, convergence. Yes, we should look at that probably. If you want me to have a look at the MACD, if it's something you're interested in, can you please send me a message after this broadcast today, and I'll add that to my list of things to look at. The RSI, on balance volume, and RSI. Well, I actually don't use the RSI. I found the slow stochastic to be more reliable. Okay, so I think that pretty much has covered Bollinger Bands. If you have more questions, please do send me messages after this, and we'll go through them. But they're very simple. It's a very what's great about this is it's just a very simple visual aid. You don't have to do anything with it. With trend lines, with Fibonacci levels, you have to actually, you know, be proactive, and you have to decide where are you going to plot the Fibonacci levels. Is this the right trend line? Have I joined the right peaks? But of course, with Bollinger Bands, it's dead simple. Are we trading sideways? Yes, I think we are. Great. I can now rely on the Bollinger Bands to give me the likely parameters. And if that matches up with my fib levels, if that matches up with my trend lines, that gives me a good reason to enter a trade here and see if I can scalp 20, 30, 40, 50 pips. Okay. Right, head and shoulders pattern I've been asked to look at. I've also been asked to look at Fibonacci levels, but I think I'm going to run out of time today. So I'm going to switch now. Do you know what? I'm going to actually go to the NASDAQ. I was going to go to the Aussie dollar for this, but I'm going to go to the NASDAQ. I'm actually going to take these Bollinger Bands off now, because that's going to be too confusing. Bollinger Bands, how do we get rid of those? Right, we need to go to... Oh, hang on. take them off. Forgotten how to take them off. What do I do? Oh yes, I need to go to active on chart. Here we go. Bollinger Bands. Get them off. Get them off. There we go. Okay, I'm going to do the same. Actually, I'm going to leave them on the 4-hour chart. Let's keep an eye on those on the 4-hour chart as we go through the week, seeing as we are in sideways trends. Now, I'm going to look at the daily chart of the Nasdaq. Now, back in February, we had something of a head and shoulders pattern. That's the weekly chart, isn't it? Yeah, thought it was. Daily chart. Now, when I started doing this with Greg back in February, we had a beautiful head and shoulders pattern here. Let's take that as an example. Right, I'm going to move this data along and pretend that we're back in sort of February. I need to scrunch that up a bit. Actually, let me scale it. That's better. That's better. Right, now let's pretend we're back here and that we don't know what's happened after that. So this is the head and shoulders pattern that I spotted when I started to join Greg doing these sessions back in February. And this is just a beautiful head and shoulders pattern that really worked fairly well. We didn't go down as much as we could have done, but right, this is key. So there's your neckline. We certainly did make some good profits out of this. Okay, let me go through the definition of a head and shoulders pattern. A head and shoulders pattern is a chart formation that appears as a baseline with 3 peaks. The outside, okay, actually, we don't need to go through that. I'll tell you that myself. The head and shoulders pattern is believed to be one of the most reliable trend reversal patterns. It is one of several top patterns that signal with varying degrees of accuracy that an uptrend is nearing its end. Now, that's slightly misleading. It is one of the most reliable trend reversal patterns only when it completes. Now, you'll see things that you think, oh, head and shoulders pattern, that looks like it's going to form, but you must wait for a break of the neckline. You get a lot of false patterns. This doesn't tell you that. It is one of the most reliable trend reversal patterns when it happens, which is why I really like to look out for them. But you absolutely have to wait until you get confirmation. I think I've emphasized that a lot in the last few months. Right, let me just see. Head and shoulders pattern. Okay, we're on the arrival. Right. Now, this is absolutely key, and I think it is stated here, but do have a look on Investopedia afterwards if you want to run through this in more detail yourself. So the head and shoulders pattern forms when a stock price rises to a peak and subsequently declines back to the base of the prior move. We'll have a look at that on my example on smart charts. But what is absolutely key, and this really frustrates me. I go on social media, I see people with experience of many, many years of technical analysis, and they're probably very successful traders, but they're going around going, this is a head and shoulders pattern, and it's in the middle of a move. So what I'm trying to say is a head and shoulders pattern is only relevant when there has been a sustained period of upward movement in the price. In other words, when we have been in a significant bull trend, as we have been in the Nasdaq. Now, you don't get a whole head and shoulders pattern. Let me try and give you an example here. Right, say we had, say the market had been basically doing this. Here we go. Right, say the market had been doing this, gone up a little bit, gone down a bit, and then gone up a bit and gone down a bit. And then say for example, this was a head and shoulders pattern, or it looked like one. We had a left shoulder here, we had a head, we had a right shoulder here. Now, it isn't in this example, but I'm just trying to explain to you why people get it so wrong. Someone would then come along and say, oh, hey, actually, do you know what? Here's a great argument. I've just spotted it. The market's gone up a tiny bit. It's rallied from here to here. Then we've come down. Then we've peaked, and then we've got another right shoulder here. I've actually completely come across this by chance, but this is actually the perfect example. Now, an inexperienced analyst will say, aha, this is a head and shoulders pattern, because we've got the big left shoulder here, the head, and the big right shoulder here. The right shoulder is just below the head. It's just fractionally above the left shoulder, but that doesn't matter. There's the neckline. When we break the neckline, we're going to collapse. Now, of course, we never broke the neckline, so there's one important point there. If you're selling it here thinking, oh yeah, we've broken the 100-day moving average, this is a head and shoulders pattern, it's going to go lower, then you're in trouble because it hasn't broken the neckline. But I think actually more importantly is the fact that, oops, don't know what that window is the fact that the market has not been in a sustained bullish trend. I mean, that head and shoulders pattern, if you can see sort of, the peak to trough is about half of the rally in the stock price from the low. That doesn't work for me. It's not, and also the pattern is bigger in terms of time. That goes April through to October, April, May, June, July, August, September, October. That's a 5-month pattern. Now, the rally only started from December to April, so that's like a January really. It's a 4-month bull trend followed by a 5-month long head and shoulders pattern. It doesn't work scale-wise. It's just not right. You have to have a sustained bull trend for a long period of time and also a long range of prices. So I hope I've explained that clearly. If I haven't, please do send me a message and I'll try and explain it more clearly tomorrow. Or indeed in the messages. Now, as we go along, here we go. Now, here you see a big bull market punctuated with consolidation. Yep, fine, fair enough. But now this is more of an example. Let me just blow this up. Oops, too much. Right, now here we have a bull trend, a serious bull trend from the low in March, which I think was the bottom of that coronavirus outbreak crisis before the Fed pumped a ridiculous sum of money into the financial markets. Now we have a big bull market going up almost a year. Very, very strong price rise, significant jump in prices. In fact, the market's doubled by the time we get here. Now I can say, is this a serious head and shoulders pattern? On the grand scale of things, it's not bigger than the rally in time or price. We have a clear left shoulder, we have a head, we have a clear right shoulder, and then we have a break of the neckline. Now the market didn't fall as much as it should have done. Actually, it didn't achieve the target. The target should have been from the peak, which was at 13,900, down to the lower of the right shoulder, which is 12,660. So the difference between 13,900 to 12,660, I'm going to call that 1,200 points. We should, if we were going to hit our target, we should have dropped 1,200 points from the neckline of the head and shoulders pattern. Now, I don't believe we did that. I believe we dropped about 400 points, was it? Yeah, okay. So that did not play out as it should have done. So yes, the head and shoulders pattern is reliable, but it must be in the right context of the move, and it must break the neckline of the head and shoulders pattern. And even then, you're not guaranteed to hit your downside target. Having said that, I've seen instances when the market has formed a head and shoulders pattern, and not only has it achieved its target, but it's continued lower. You often see head and shoulders patterns at the top of a crash. Now, I've been doing this for so long that I was doing this over the global financial crisis, 2007, 2008. Now, I had clients like Deutsche Bank, Morgan Stanley, Merrill Lynch, big clients like that, Credit Suisse. And I said to these guys, these are all options traders. I was writing, beware, this looks bad. We've got a topping pattern, and nothing fundamentally in the news was saying that the market was going to crash. And my clients were saying, "Are you sure? We really can't see a crash coming." And then bang! I actually remember where I was. I was on holiday in Ibiza, and bang, the market broke. And all my clients were going, "I don't know how you did that. I don't know how you knew that was coming." And it was simple. It was just a head and shoulders pattern. Anyone who studied technical analysis could have seen it coming, and the market absolutely collapsed. So they certainly stayed with me for a number of years. Okay, I've gone way over time, as I always do. I hope that's useful. Do go on to Investopedia. I didn't talk about an inverse head and shoulders pattern. So maybe if you would like me to do that, I can do that tomorrow. So please send me a message if you would like me to go through an inverse head and shoulders pattern. It really is just a reversal of that head and shoulders pattern. It's at the bottom of a bear trend. It's very easy to understand. It's just a mirror image of what I've shown you today. Yeah, any questions, please do send them to me. Join